Hey, I'm Sean with The Modest Wallet. In this video, I'll explain how to invest in dividend stocks as a beginner.
Easy on me, I'm a beginner.
I'm going to walk you through the process step by step, along with a few handy tips that you might find useful as you look to move forward with your dividend investment portfolio. If you're new to the channel, I'm glad you're here. Don't forget to click that subscribe button, click the little bell so you get notifications every time that we release a new video, a new Money Made Simple video. In particular today, I wanted to talk to you about how dividend stocks really work, why companies pay dividends, and really finally, and maybe this might be the most important thing, how to invest in dividend stocks. Let's not waste any time. Let's first look at how dividend stocks work. Dividend stocks are public companies that distribute some of their profits to their shareholders.
To the shareholders meeting.
When a company has excess profits that it does not plan to really reinvest back into future growth, the company usually plans to pay a dividend or payment to those that are invested in that stock. This typically happens every 3 months, but really every company's different. Dividend payments are usually evaluated through something called yield. This lets you as an investor know how competitive the dividend stocks really are going to be. For example, ExxonMobil, which is one of the better dividend stocks to own in terms of its yield, stands at well over 5%, and that's from Q2 2021. Now let's take a look at why companies pay those dividends. If you haven't figured it out yet, not all companies pay those dividends, so you'll need to do some homework to find suitable stocks that really are going to meet your financial goals. Some of the biggest and really most successful companies in the world choose not to even pay any dividend payments. This includes companies like Alphabet, Facebook, and Amazon, which to date have never paid a single cent in dividends. In terms of receiving a dividend, the company's board of directors will initially meet to decide how much they're going to pay. They will also announce a record date. The company identifies all shareholders of the company on that day. To be eligible for the dividend, you must buy the stock at least 2 business days before the date of record. Then there's the ex-dividend date. And this is the date which is usually 1 business day really before that record date. Hopefully I'm not confusing you, but if you're in possession of the stock before the ex-dividend date, you are essentially entitled to a payment. The dividend payment is then distributed to all shareholders on the payable date at an amount proportionate to the number of shares you own. Let's look at an example. Suppose you own or are holding 1,000 ExxonMobil stocks. ExxonMobil will announce that it is paying a dividend, let's say of 87 cents per share. This means that you will receive a payment of $870. Now, in most cases, the payment will be distributed to the brokerage that you're holding the shares with. So this means you'll see the payment reflected in your trading account. You'll then withdraw the money back to your bank account or reinvest the dividends into other assets. Now that I hopefully provided a basic understanding of dividend stocks and how they work, let's look at 7 basic steps for how to invest in dividend stocks. First, you need to research companies that offer dividends. In this step, you really just need to do it on your own. After all, there are thousands of public companies that pay regular dividends. To really get the ball rolling, it might be worth it to just use a stock screener. I'll share my screen because this allows you to filter stocks down so that you are only viewing companies that are paying those dividends. As you can see on the screen, you can often sort the results by the dividend yield as well. And if your brokerage doesn't offer an in-house stock screener, you can access one through Yahoo Finance, TradingView, StockRover, FinViz, and Trade Ideas. And that's just really to name a few. Another way you can find dividend stocks is to look at dividend aristocrats. These are companies that have increased the size of their dividend every quarter for at least 25 consecutive years. You then have dividend kings, which have achieved this goal for at least 50 years. The second step is to evaluate the stock. Once you've narrowed it down to a few potential dividend stocks to invest in, you then need to perform some research on the companies itself. Just because a stock pays an attractive yield, it doesn't mean it's a great stock or a company to really be invested in. Something else you really need to consider is the share price of the stock and whether it has the potential to increase over time or at least in the medium term. For example, let's suppose that you invest in a dividend stock that is currently yielding 7%. Sure, that does offer an above average yield, but if the share price itself declines by, let's say, maybe 15%, then really the value of your investment is now worthless. With this in mind, and there really are some key metrics that you need to consider before proceeding, a good starting point is to focus on key accounting ratios, such as the price to earnings ratio or the PE ratio. This looks at the current share price of the company against that of its earnings per share. Once you have obtained that PE ratio, you then need to compare this to the sector average. If the dividend stock in question has a PE ratio that is a little bit higher than this average, it could mean that the shares are a little overvalued. Some other accounting ratios that are worth considering when researching a potential dividend stock include the earnings per share or the EPS, the cash dividend payout, the debt to equity, the price to book, and operating profit margin. We will hopefully go further in depth with these ratios, but it's now time to move on to step 3. The third step is to decide how much to invest in dividend stocks. While dividend stocks should always play a part of your wider portfolio, other share types should be considered too. For example, you might decide to allocate some funds into growth stocks. A specific split between the financial instruments should be based on your financial goals and your tolerance toward risk. In another example, a conservative portfolio might have a stronger focus on those dividend aristocrats or kings. Those with a higher appetite for risk might decide to allocate more towards growth stocks. Either way, you will also need to come up with an investment strategy. That leads us to step 4 in how to invest in dividend stocks, and that is to open a brokerage account. By now, you should know which shares you want to buy. If that's the case, you will then need to head over to your brokerage platform and complete that investment. If you don't have a brokerage account, there are plenty of options available to those if you're in the United States. Many online brokers now allow you to invest in US listed stocks on 0% commission basis. Step 5 for how to invest in dividend stocks is to place your order. You can complete the dividend investment process by placing an order with your brokerage. If you're completely new to the world of online investing though, placing an order doesn't have to be difficult. There are several reasons for this, but this is because you can elect to place a market order, which means the brokerage will really execute your trade at the next best available price. If you want to enter the market at a specific price, you might even consider a limit order. To explain this further, let's look at an example with Johnson & Johnson. It might be priced, let's say, $164 per share, but you might not want to invest until the stock drops to $160. You might also want to consider a stop loss order, which is more appropriate for short-term trading. This order type allows you to automatically sell an investment when it goes down by a certain amount. For example, you might elect to cut your losses if the dividend stock drops by more than maybe 10% in value. Moving on to step 6, which is to keep reinvesting your dividends, otherwise known as DRIP. One of the most attractive aspects of investing in dividend stocks is that you have the potential to benefit from the long-term impact of compound interest, which is essentially where you earn that interest on interest. This can actually be achieved by creating a dividend reinvestment plan, otherwise known as DRIP, which means that every time you receive a payment, you reinvest the dividends back into another stock. We're considering a lot of different examples, but if you consider an example of having maybe $5,000 worth of dividend stocks with an annualized dividend yield of, let's say, 5%, without any share price growth, which doesn't happen, but for our example, consider it does, you would have made $250 in dividend payments. You could withdraw that payment and have $5,000 left, but with DRIP, or a DRIP, you would take the $250 and reinvest it at 5%. And I won't go into crazy details, but you can see how that could really add up year over year. The key takeaway with the DRIP strategy is that by avoiding withdrawing your dividends, you can grow your wealth much faster as you will continuously be building your stock position. The last step for how to invest in dividend stocks is to monitor your dividends. It is incredibly important to regularly keep tabs on how each company is performing. After all, there is no real guarantee that your chosen stocks will continue to pay those dividends. Great example of this is when the COVID-19 pandemic started in March of 2020. Many S&P 500 companies decided to either cut or outright suspend their dividends. You also need to look beyond just the dividend payment itself. As I mentioned earlier, the share price of your chosen dividend stocks is just as, if not really as more important than the actual yield. If at any point some of your dividend stocks are no longer aligned with your financial goals, it might be time to really rebalance your portfolio. We just cranked out a lot of valuable information in regards to dividend stocks, so I wanted to take some time just to briefly take a look at some of the major benefits of dividend stocks. First is the regular income. Perhaps the most obvious benefit of investing in dividend stocks is that you have the opportunity to earn regular income, which you can either keep or reinvest. Second is that you're going to be typically investing really oftentimes in very established companies. For a company to pay dividends, it will need to have sufficient cash flow levels, so you will often find that dividend paying stocks are well beyond their growth stage, and because of this are now established companies. This often means less risk. Third on the list is that you can focus on dividend specific ETFs. You have your heart set on really building a portfolio of dividend stocks but can't quite decide which companies to choose. There are now plenty of dividend paying ETFs that can streamline the process for you. We have a great video about how to invest in ETFs, and I'll leave a card above for you to access that. Benefits outweigh the downfalls, but nonetheless, I would be doing you a real disservice without mentioning the downfalls of investing in dividend stocks that really stand out to me. One of the biggest drawbacks when investing in dividend stocks is that it's all too easy to be fixated on yields. You might overlook the fact that the stock is potentially overvalued simply because it is paying what many would consider to be an above average dividend. An attractive dividend will still lose you money if the value of its share price drops by a larger amount than the yield itself. Second downfall is that the upside potential will be limited. Sure, you might enjoy a consistent dividend payment, but there is only so much that these companies can grow year over year. The third and final downfall to these dividend stocks that I will mention today is that cuts and suspensions to dividends can occur. There is never any guarantee that your chosen dividend stock will continue to pay out at any given time. A firm's board of directors can decide to cut or even suspend its dividend. I really hope this video has been helpful to you and hopefully helped you walk through the process of investing in dividend stock. If it has been, then definitely click that like button. That really does help us out. On top of covering the basics of how to complete the investment process, I've also explained the many things to consider when choosing the right dividend stocks for your portfolio. And that doesn't go without saying that I have also explored the many risks that need to be considered before proceeding. Ultimately, whichever dividend stocks you decide to invest in, just make sure that you are well diversified and that you consider a long-term DRIP strategy. Let us know your favorite dividend stocks or ETFs in the comments below. The comment section is also a great way for us to really communicate and really build the Modest Wallet community. Thanks for checking out our video. Don't forget to subscribe so that you can make sure that you know when we're going to be releasing our next video. And with that said, I will see you in the next video.